Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 6, 2016. Wanted to do a video overview of just really take a look at everything. Most of the broad markets, the U.S. stock indices, a couple sectors, and things like commodities. So just this will be, we'll touch lightly on everything, just kind of give a heads up where we're at, what to look for, whether it's gold, oil, equities. And I'll start out here since we're on the chart of QQQ, taking a look at the U.S. equity markets. Uh, as I've been highlighting recently, this 104.90-ish area was a pretty key support level. We danced around that for several days and finally broke through there. Today we're, a solid break, and we've been trading below that level throughout most of the trading session. So pretty safe to say that level's gone, which does open the door for a move down to my next target here, which is 103.35. That's horizontal price support, as well as the 50% Fibonacci retracement that goes back from the move off the February lows there up to the high. So you have both price and fib support. That's usually what I like to see when they line up together, and it's rarely a coincidence that these levels do usually line up. It's just how the markets trade. All right, so you can see the trend indicators, as I mentioned, remain clearly bearish, and this is on the 60-minute time frame. As I've stated quite a bit recently, my long-term monthly trend indicators remain bearish on every index, every major U.S. index except the NASDAQ 100, which actually now those trend indicators are flashing sell signals. However, we're in early May, so we have to wait till the end of the month to have a confirmed sell signal. But again, I've stated that doesn't matter because just about every other index I follow, the S&P 500, small caps, mid caps, you name it, the Wilshire 5000, they're all confirming that the longer term trend is bearish. So as I've stated, I've viewed the rally off the February lows as most likely just a bear market rally, and that's why I'm, you know, holding on. I'm swing trading this one down, thinking there's a very good chance. In fact, we really have no business going over these recent highs. We rolled over there. If that was a bear market rally indeed, take a look at the daily chart. There's the cues from daily time frame. We really have no business taking out that level, or obviously then, at least in the cues, you couldn't say it's a bear market rally, because if the market goes on to make new highs, well, that would technically be let's just say we punch up, make new highs and fail. That would have been the end of the bull market. So either way, we had, like I said, the case has been made for quite a while here over the last week or so for a broad-based sell-off, and so far that's what we're seeing. Just about every sector I track has moved down with this sell-off. So I remain short. Might lighten a little bit up over the weekend, and I'll show you why here in a second. But for the most part, I'm swinging. I have positions that I'm establishing for what could very well turn out to be multi-week, even multi-month swing trades on the short side. And again, all the case has been made: the bearish divergences, the steep rising wedge, the bull trap fake out, the failure at that 78 fib. And then going back to that 60-minute chart, this is the downtrend channel that we've been in since the highs on the Qs back in mid-April. Trend indicators are solidly bearish at this time. That 104.90 support's broken. That opens the door up to a move down to that 103.35, the next level, which comes in with a 50% fib retracement. And I mentioned recently this bullish falling wedge pattern setting up on the 15-minute time frame. Very well, nice defined downtrend line. And so far the bulls have failed to capitalize on that. Now I had that drawn this way, and I mentioned either in the trading room or on the front page yesterday the possibility, to keep the bullish case alive, at least for a rally, is that these divergences that were in place below, I've already extended them here. I had them drawn out here the other day. I mentioned that there's plenty of room to thrust down, maybe even hit that next downside target that I have, and that would just extend this wedge. In other words, it looks something like this, and maybe we go down, have another low, a little bit lower, and then reverse, as long as these divergences stay intact. So this is what I had mentioned earlier, is giving me a little bit of pause. And, the reason I might lighten up a little on my exposure over the weekend and then just follow up next week to see how things go. But as of now, like I say, even if barring a bounce or a rally up to any of these levels, this would really be my comfort threshold level on a counter trend rally here. If we get much above that resistance level, 108.13-ish, That will then sort of call in the longer term bearish case into question. All right, let's look at some of the other markets, or indices, I should say. Here's the SPY, looking at SPY on a 60-minute. There's that ascending price channel. We had a beautiful, just nice, clean. This was pretty well defined. Breakdown, back test, prices rolling over. We're at that 204 support level. We hit it today and bounced. If you look at a 1-minute chart, you'll see a little closer. We hit that level actually on quite a few. Look at all the 60-minute sticks that have held on that 204 level I've had there for a while. And if and when that breaks, which is my expectation, sell signals in place on the 60-minute time frame, these bearish trend indicators, and whether we get a bounce here or not, I still think this is a very likely near-term target zone. What I mean by that is we're more than likely to hit this level before we go up any much above, probably that 207 level. I would say would probably contain any bounce from here before that level's hit. At least that's my read on the charts right now. So bearish on the SPY. Here's the MDY. This is the mid-cap ETF. Tracks the mid-cap index. And you can just clean, breakdown, back test. They all look the same. Trend indicators are bearish. We had the negative divergence leading up to the highs recently. So like I said, I haven't seen a clearer case to short the markets in quite a while. So that's here. There we are. The IWM, the small caps, breakdown back test, which is circled, moving down. Here's a nice support zone target there around 108.07, the top of that zone. And ultimately, I think in the coming weeks to maybe months, this 102.72 area is a very likely target. And like everything else, all the trend indicators on this time frame, this 60-minute time frame, are bearish. Okay, let's change gears, look at something else. Before I get away from the broad markets, we'll look at only one stock, and that would be, of course, Apple, the world's largest company, the leader of the Qs, and just about everything else out there. So Apple is starting to dip below. It's not an impulsive breakdown yet, and being that it's Friday, I doubt we're going to see any fireworks into the close today. So this will all have to be continued next week. But so far, you can see we're cracking. I have two lines here, the orange line, and then just below it, there's actually a few reaction lows. You can see those were intraday moves because those are just the shadows of the candlesticks. There's one. We had that mini crash here back in August of last year. But you can see very well-defined support level, what I consider very critical support level for Apple. And I've been making the case since really not far after the April 28th highs, and then once we had all the confirmation, all the trend indicators, I use it. This stock is in a new bear market, and that has clearly been the case since that April 28th high back last year. And we had, like any bear market, you have these bear market rallies. They're very lucrative to trade if you get on the right side of them, but this is one I think that's going low over time. But we need to see a little more evidence. That, again, this intraday breakout doesn't mean much how we close the day. And as I said, this will be to be continued next week, no matter what happens. Even if we close just a little bit below it, it's not, you want to see a breakdown with impulsive selling, high volume, a sharp, drop, prices moving well away from there, and a daily close below that level to really say that Apple's broken that support level. So right now it's just clinging to it. All right, let's look at a few other things. I know a lot are interested in gold, GDX. I'm still short some nugget. That's an unofficial trade idea. Unofficial meaning there won't necessarily be any follow-up post. If you have questions, sure, you can ask me, but price targets, stops, all that. When you're on your own, it's just a trade that I'm doing and something I see. I'm not happy today with this reaction. What's happened in gold, and I posted this in the trading room. We had that gap from the other day. Here's the April 27th and April 28th, or April 28th to April 29th. So we had a big gap up on April 29th that broke out. Gold broke out to new multi-month highs, maybe even multi-year highs. That goes all the way back. 52-week high at least, I believe. And fell back, and it back tested that gap the last 2 days. I really wanted to see that gap go, but it held. It defended gap support. It bounced perfectly the first time around, made a little pierce below, but closed well above that gap, and I'm referring to here. And so far, this move up is just what I often state, the initial tag of support from above. often produces a reaction. This is the initial tag. You had the gap here, then that gap was backfilled, and more often than not, when a gap is backfilled for the first time, you have a reaction. So I'm not overly concerned right now. I was fortunate enough to short nugget right near the top, and you can see there's a potential trend line here I have. So I can see gold and GDX possibly going on to make a marginal new high. I don't want to see it. I'm not favoring that right now, but that's still very much keep the bearish case intact. Here's GDX. GDX, just like gold I showed you a minute ago, found support. So did GDX. GDX has this trend line that's pretty well defined off the January lows. So that were the multi-year, decade lows in GDX, and that defines a move up so far. We'll look at that on the 60-minute chart as well. But you can also see here we had 1, 2 reactions off that level. So basically that's a large rising wedge pattern confirmed with divergences, as I've pointed out here, negative divergences, which help indicate a likely trend reversal. And we had, it found support there, found support again the next day, and we moved up. So just like gold, this is the initial bounce or initial reaction. I was hoping and expecting a breakdown there. Now we had a bounce, and again, you wouldn't want to wait. You wouldn't want to short that GDX or add to it unless this level goes. So no matter how high we bounce, I won't add. I'm more concerned about stopping out if we go much above the highs, or who knows. GDX can do whatever it wants. It's just been tremendously bullish lately, and it might want to make a run, maybe even a wedge overthrow before we go. I won't let it get that far, my position get that far underwater. I'll just come back if it does a wedge overthrow, pops up through the top side of this wedge and then comes back in, I can always re-enter. So right, like I said, as long as those divergences are in place, and I already made the case in a video as to why with a lot of the top components of GDX, the individual mining stocks at or very close to huge resistance levels. That was the reasoning for my GDX short. So just want to share my thoughts. And we also had a fundamental cause for the bounce today. We had those weak job numbers. Weak job numbers, of course, gives the Fed more fuel or reason to keep rates low, which is bearish for the dollar. However, as I'm doing the video and all day, see, the dollar didn't really take it. I've made the case recently for a near-term bullish case, in other words, a bounce on the dollar, and a longer-term bearish case on the dollar. Shows well on a 60-minute chart, actually a 2-hour chart. Let's look at that. So the dollar, you can see here, it's down 0.08%. UUP I'm using as far as the dollar index. And it does have resistance right here, and it rolled off that resistance. You can see a pretty nice level. But we're working our way down within this large bullish falling wedge, confirmed with divergence. Maybe another thrust down. Here's we have a couple gaps. UUP will always be gappy like this. You'll see a history of gaps because this is just the ETF, and this just shows normal trading hours on the U.S. markets, 9:30 to 4, whereas the dollar and all other currencies trade around the clock. That's why you're going to see gaps in any currency tracking ETFs. But there it is. So like I said, the near-term case, I believe, is bullish, and the fact that the dollar is only trading virtually flat with that news, the weak jobs report today, tells me that there's a bid underneath there, and then we'll probably see the dollar continue to move up in the coming weeks, which should put pressure on gold and GDX to the downside, as well as some other things. So let's roll into the other commodities that everybody's watching right now. USO, I've got quite a few charts here. Just there's so much to cover in these charts. I try to keep these videos as short as possible, but there's just so much to mention here. What we're looking for here, there's a potential. The 1333. No, that's not the 1333 pair. This is the MACD. I don't have the 1333 on this time frame, but the MACD I use as a trend indicator as well. When that signal line, the 9 EMA, crosses below, when you're trading below, you're in a bearish intermediate trend. This is a 2-hour chart. I'll get to the 60-minute chart in a second. But you can see the divergence right here. See the negative divergence on the MACD, the RSI, versus this rising wedge pattern. So basically you had a breakdown, back test. This is a very key support level. It was a big resistance level, support back here, big gap, which further validates that level. Reaction high, reaction high. So, the bullish and bearish case can be made for USO. And, bullish that it recently broke out. Bearish, we had this rising wedge pattern, broke down, back tested. And I'm still near-term bearish, and I'm short the energy sector via two different ETFs. I have ERX, I think it is, and the Gush, which is the E&P sector within the energy sector, exploration and production. And I think there's more downside to come in these as well. So, like I said, bullish case is the recent breakout. Now, if this breakout fails, if it goes much below that 1067 level, that's going to be a bearish event. That'll be a failed breakout above this level again. And we'll probably see prices move all the way down to that 990 area. Let's take a look at USO on a daily chart. Similar thing here. This divergence no longer matters. I have to take that away because we made a higher high in the RSI. Although there is still divergence in place. It looks like about an equal high on the MACD right here against. And again, this just picks up on that 2-hour chart I was just showing. It's the similar wedge pattern. I have it drawn different here. I have a different uptrend line actually, giving that one a little more room. Now, important to note is this blue downtrend line. This comes all the way off the mid-2015 highs, captures of several reactions. So we recently broke out. Again, there's the bullish in case for USO, the breakout above that downtrend line, and we're currently back testing it. Will that breakout hold and prices move up, or are we going to ride the downtrend line or fail and come back in there? So, I'm not doing anything on crude itself. I'm more comfortable shorting the energy sector stocks because, as I said, broad market sell-off brings everything down. All sectors get sold, and I would rather at this point play the energy stocks than the underlying commodity, i.e. oil. All right, let's see if I had anything else to cover there. 60-minute chart. Yeah, there's a 60-minute chart I said I'd get to. Trend indicators bearish, just slightly wanting to flip to bullish. Sometimes you have these whipsaw signals, but we had, most importantly, we had this divergent high on the 60-minute chart. It was very clear on just about all price and momentum indicators. And you see the breakdown, back test. But we need to give that 1067-ish, call it 1065 if you want to round off, be safe. That level needs to go to strengthen the bearish case, and I do think that happens. You can see the MACD is now in bearish territory. That white line, the signal line, the 90 EMA is still just below the 0.02 you're seeing. That's the MACD line, the 1226. I like to use the signal line as a trend indicator. So, like I said, nothing to get overly aggressive, but if you do see this level go and 1065, then you could probably get a short on USO all the way down to that 990 area. All right, we already covered gold. Let's see what else is there. Okay, I'll wrap up with natural gas. Using the ETF here, UNG. I don't have my stock charts up. Those I have the spot prices of natural gas. I've showed those charts before. This is just a long term. This is a weekly chart, a 10-year weekly chart. And you can see with the PPO and the MACD, the RSI, you have a divergent low here, quite a bit too, going back up several years. Prices making a lower low against the PPO and RSI making a higher or about an equal low there in that case. And if you zoom in a little closer, you have this sort of a descending price channel here that UNG is in. So I remain, as I've stated, longer term bullish, but near term there's some mixed bag on the technicals, if you will. Similar to USO, you have this downtrend line here. You had a breakout, a recent breakout of that downtrend line, and prices have back tested. And I have this the yellow lines here you can see is sort of an ascending price channel. And we're coming up on that. That should act as support. If that doesn't hold, we have support around 635. Let's take a look at the 60-minute chart and show you that line. I don't have the upper line shown here, but this is the downtrend line. So you can see it's a pretty well-defined downtrend line. And UNG is at that. I think I mentioned just back here recently a tag of that level would provide an objective long entry. Now, we had a bounce there. I have to say I'm leaning towards, as I mentioned before, quite a bit, a broad-based sell-off, which takes just about everything down with it. And I think that oil and UNG might move lower in the coming weeks here. At least that's my suspicion. So I don't have any position right now on natural gas, but I did want to cover that because I know it's been talked about recently. So those are some levels to watch. And if we did pull back, if that line did go, maybe this 615 might be a target. That would take us not far off the lows, but that's a possibility. So just one to keep an eye on for. I don't have any other levels really marked up here. These were former lines. They might not be as important now, but I would mention about 640 might be a level 2 to watch, as well as the one above it, which is 647. All right, this has been Randy Finney with the right side of the chart. I hope you enjoyed.